Okay, we want to diversify our portfolio a little bit, and when we do that, I mean, we can do strictly ETF, and index options and so forth to build our portfolios. But sometimes it really does pay to have a stock or two in the portfolio because, not all stocks move exactly the same as the market. Some stocks are going to go up when the market's going down, and some stocks are going to go down when the market's going up. And that really helps diversify the price risk that you have in your portfolio. So, you want to take a look at stocks that have good and liquid options in them. IBM is one of those stocks. You also want stocks that have a good chart. And a good chart, by what I mean a good chart, is that it looks like it's either trending or it looks like it's channeling in some way. And let's take a look at IBM here just for a minute. If you go to your profit charts and click on profit and then type in IBM and click enter, you'll see a chart of IBM here. Let's do a real quick little, let's take a quick look at that and draw a little channel around it and see where the price has been and where we think it's going. If we draw a quick channel line on this, it looks like IBM right now is up around 126. And it looks like it's had a pretty good run. It's run up from about 96 maybe back in the beginning of January all the way up to 127. And for IBM, that's a pretty good move. And so they've been, it's been moving inside of this little channel going up all the way up to, I think the high here looks like it's around 129 maybe. If I just put my cursor over there, I can see it's 128.68. So let's say we wanted to do something with IBM because IBM looks like it's kind of topping out here, and we may get some sideways action, or it might move down a little bit. Who knows? But it looks like it would be a good candidate for us. So let's go to our trade tab in our Thinkorswim platform. Go over to trade tab. We'll pull up IBM and pull up the June options. Now there's one thing that we want to look at before we really start to take a look at these options, and that is, close up, you want to close up your option months. So the arrow for June of '08 should be pointing towards the June and not down, so you don't have the options open. And the same with July. And for all the months. So what we want to do is we want to go over to the right side and take a look at what's called the implied volatility of these options. If we follow June all the way across, we can see that the implied volatility is 21.1. July it's 23.4. October it's 25.6. And if we were going to do a calendar spread on any one of these, what we want ideally is something called a positive skew. A positive skew means that the front month, which would be June in this case, has a higher implied volatility than the second month that we're going to be buying. The reason for that is that volatility increases the price of the option. So we want to sell the option for as much as we can possibly get. And if the implied volatility is higher in the front month, that means the options are actually more expensive than the ones in the second month, and those are the ones we're selling. So that actually works in our favor because we want to sell them for as much as we possibly can. So if we take a look at June, we see that it's 21.1% implied volatility. The July is 23.4. If we subtract those two from each other, we have a negative number. We have a negative 2.3 approximately. So that's a negative skew. We don't like negative skews normally over 2 points. So we're not going to do IBM at this point. What we'd like to have ideally is an option in the front month that has a higher implied volatility than the one in the second month. So let's take a look at another stock. In this case, let's pull up MNST. Okay, MNST is Monster Worldwide. They run a website for people who are looking for a job. And in this case, you can see that the June options, the front month options We're still in our trade tab here. We want to take a look at MNST is the option symbol. And if we follow June across, we see that it has an implied volatility of 51.2. 51.22 to be exact. The July options have an implied volatility of 47.53. Now remember that the front month, if it has a higher implied volatility than the second month that we'd be selling, is called a positive skew. You take the front month of June is 51.2 and you subtract it from the 47.5 and you get a number. In this case it'll probably be looks like it's going to be about 370 3.7% positive skew. Now generally when that happens, when you have something more than 2 points over a positive skew, so that in this case it's 3.7 positive skew, it means that the probability is that they have earnings coming out very shortly. And that's why the options have such a positive skew on them. If that's the case, then what we need to do is take a look at our profit charts here.